Hi, I'm Lance Roberts, Chief Investment Strategist for RIA Advisors with today's Technically Speaking update about the markets and what we're doing here at the shop relating to your money. Over the course of the last couple of months, we have been watching this rally from the December 24th lows, and while we've maintained some exposure to the markets, we've been primarily underweight a lot of this rally here because of the impact of what we call a reflexive rally. We had a very, very extensive drawdown in the market, so it wasn't surprising that we would have a reflexive rally. But most importantly is that we haven't really resolved a lot of the technical issues of the markets on a longer term basis. And again, while this rally's been very sharp from these lows, we're basically only back to where we were in January of last year. So over the course of the last 15 months, the markets haven't made a tremendous amount of progress. And again, while we're concerned about short-term movements in the markets, and we do want to try to participate, the concern about the longer-term dynamics of the markets are also more important, particularly in a very late-stage cycle of the market as we are in currently. Importantly here, as we watch this, we did add some exposure here just recently. The markets had gotten above important resistance here at the 200-day moving average, corrected back to it, and at that point was holding that support. So with that holding of support, we did work off some of the overbought condition, and we can see it right here. We were overbought, the market quickly reversed to an oversold condition, so we added some exposure to our models at that point, have enjoyed this rally back up, but again, concerningly enough, we are now back to an overbought condition on a daily basis. Now this suggests that in the near term, we could see a bit of choppiness in the markets, and kind of going back to look at where we are, again, we're still kind of within this overall range of the markets here that really go back to October, November of last year. And in fact, we're just really kind of pointing here at levels at the beginning of October where the market had begun to break down. So we're moving up into this previous range where the markets had peaked previously. So while we added some exposure here, we're still holding higher levels of cash currently, at least to try to protect some of the potential risk in the portfolios. And this is particularly the case as we step out on a weekly basis. The oversold condition that we saw back in December, the markets have gotten extremely oversold, is now back to extremely overbought on a weekly basis. Now, this is a much slower moving chart, which means that overbought conditions have a much more important narrative in terms of where markets are. And again, if we look at where the markets are currently versus the last time we got into these overbought conditions, it's reasonable the markets could try to test all-time highs, but we are moving into a big cluster of resistance where the market is overbought. We would expect to see this market correct and consolidate along the 200-day moving average before trying to make a larger attempt higher. The one good dynamic here that gives us some bullish outlook here, at least here temporarily, is that the markets on a monthly basis are not back to completely overbought yet. Now, one of the big concerns here, though, is if we take a look at this market pattern, we had this peak in January, we had a higher peak in June of last year, and now we're coming up to retest that previous peak of January. This is very typical of a market topping process. And again, while the markets here are doing well in the short term, we really haven't completed this consolidation process from January of last year. What will resolve that will be a break to new all-time highs. Now, we're not there yet, and until that happens, we have to remain a bit cautious here about the outlook for the markets if this is indeed a broader topping process. And there are indications that this could well be the case. And in fact, if we go back to 2008, it's a long way from here to there, but you can see exactly the same type of topping process that was occurring back in 2008. Markets extremely overbought on a monthly basis. The markets topped and then had a bigger correction. We had the same type of topping process in 2015, 2016. Market very overbought on a short-term base, on a monthly basis, corrected. The one thing that saved the market to this point was a lot of central bank interventions from the ECB, from the Federal Reserve, etc. The markets took off because of that injection of liquidity from the European Central Bank. But here we are once again into this topping process. Again, resolving that topping process is going to require a break to all-time highs. We're not there yet, so we want to remain a bit cautious until it happens. Yes, we're going to give up a little bit of return in the short term, but the benefit of that is if this market does begin to break down, if we do begin to see a recession here in the next couple of months, the average drawdown for a market in a recessionary environment, particularly one as debt-laden as we have currently, will be two issues between 30 and 50% on average. So keep a watch on this. That's why we're being a little bit more cautious here. But if we do break all-time highs, we'll increase market exposure back to full weights. We are adding some exposure on opportunity to try to participate some more, but still, again, being very cautious here. That's our wrap up for the day. I'm your host, Lance Roberts, Chief Investment Strategist for RIA Advisors. Be sure to go by our website, realinvestmentadvice.com. All of our latest commentaries, market updates, and more you'll find there, as well as our YouTube channel right there at our YouTube tab at realinvestmentadvice.com with all of our latest podcasts, updates, and more. Thanks for joining.